Welcome back to another edition of The Explainer. You know, there's a wild statistic out there. A staggering percentage of new day traders literally blow up their entire accounts in the first 30 days. Yeah, it's brutal. Today, we're tackling exactly why that happens by diving into one of the most hotly debated topics in the entire crypto space. If you've ever opened a chart and just felt instantly overwhelmed by the sheer number of options, I mean, everything from the slow crawl of a monthly candle down to those dizzying 1-second ticks, you are absolutely in the right place. We're analyzing source material from top crypto educators to build what we call the crypto timeframe funnel. We're going to journey from broad market timeframes all the way down to micro scalping, specifically focusing on the intense, high-speed world of Bitcoin trading.
Okay, let's dive right into how we're going to break this down. First, we'll hit the timeframe dilemma. Second, defining scalping. Third, the 5-minute approach. Fourth, rule-based execution. And finally, number 5, protecting your small account.
So what is the absolute best time frame for crypto trading? It's the universal beginner question, right? And it's usually the very first roadblock you hit. Imagine this. You're looking at a massive Bitcoin rally on the daily chart. Everything looks incredibly bullish. But then you zoom into the 15-minute chart and it looks like a brutal, terrifying downtrend. It's like looking at two completely different realities. This contradiction causes hesitation, anxiety, and ultimately, bad entries. Our sources emphasize that before you can ever trade successfully, you have to align your time frame with your personal psychology, your risk tolerance, and your actual daily schedule.
All right, Section 1, the time frame dilemma, broad versus micro. Think about the pure psychological agony of swing trading for a second. You might hold a Bitcoin position for days, maybe even weeks, patiently analyzing the daily or 4-hour charts to ride out these massive macroeconomic waves, only to wake up and find out a sudden 3 a.m. market crash wiped out all your profits while you were fast asleep. Now contrast that with scalping, where you're living right in the trenches of the 5-minute and 1-minute charts. The source material reveals this massive shift in the trading community toward these micro time frames, mostly because traders want immediate gratification. They want in, they want to capture profit, and they want to be totally out of the market in under an hour. But here's the catch. This hyper-fast scalping demands an entirely different, incredibly rigid psychological makeup.
Moving into Section 2, defining scalping. The need for speed.
So what exactly is scalping? Basically, it's a super fast-paced trading strategy aimed at profiting from minor price changes in highly frequent short time frames. Think 1 to 5 minutes. In the world of Bitcoin, timing matters more than absolutely anything else for these fast trades. You aren't looking for Bitcoin to move $10,000 over 6 months. You are looking for a quick, localized burst of momentum right now. The educators in our sources stress that scalping is not about predicting the grand future of cryptocurrency. It's simply about capturing a tiny, immediate slice of market volatility, maybe just a quick $50 price jump, and getting out safely before the broader trend even has time to react.
Section 3, the 5-minute approach. Is this a trader's sweet spot?
You know the hype I'm talking about. Those videos promoting crazy win rates and so-called sniper entries. But the reality is, those win rates only exist if you possess absolute robotic discipline about exactly when you click buy or sell. For Bitcoin, you absolutely cannot scalp 24/7. The highest win rates only happen during specific high volatility hours. We're talking the London Open, the New York Open, and especially that crucial overlap period between the two. During those windows, institutional liquidity literally pours into the market, giving you that clean, directional momentum you need for a 5-minute scalp. If you try to force a trade during the notoriously slow Asian session, well, you aren't really trading. You're just staring at a screen for hours, getting slowly chopped up by low volatility fakeouts and algorithmic noise.
Which brings us to Section 4, Rule-Based Execution, the system.
Professional scalpers survive because they rely on a strict 3-step checklist. Step 1 is strategy alignment. You have to check a slightly higher time frame like the 15-minute chart, just to make sure you aren't trading directly into a major brick wall of resistance. Step 2 is confirmation. This is where you zoom in on the actual 5-minute candles. Are you seeing a strong, full-bodied, bullish green candle closing decisively during that New York Open? Or are you seeing a weak, exhausted candle with a massive long wick at the top signaling a total fakeout? You have to wait for the candle to close to confirm the real volume. And step 3 is entry mode execution. The very second confirmation happens, you execute. Actually, scratch that. You don't just execute. You execute mechanically, without a single moment of hesitation.
So why is this exact checklist absolutely crucial? First and foremost, it completely eliminates emotional guesswork. Scalping psychology is notoriously brutal.
Imagine a sudden Bitcoin candle shoots up $500 in 2 minutes. The fear of missing out, the FOMO, screams at your brain to jump in blindly at the absolute top. A rigid checklist actively stops that. It also prevents the dreaded boredom trade. You know, those terrible, low-probability entries you take just because you've been staring at a stagnant chart for 3 hours and feel this itchy need to just do something. This rule-based approach works powerfully across crypto, forex, and gold, but honestly, only if you have the patience to sit on your hands and wait for those explosive, high-volatility windows to actually open.
Finally, Section 5, Protecting Your Small Account, the Reality Check. The experts in our source material are brutally honest here. Your small account is dying because of this. Because of what exactly? Because of poor risk management in fast-moving markets. When you're scalping the 5-minute chart, Bitcoin can reverse violently in a matter of seconds, completely wiping out hours of hard work. To survive, you must use an incredibly tight stop loss. You have to use fractionally small position sizes relative to your total capital. Because if you over-leverage during a fast move and the market fakes out against you, man, your entire account can be decimated before you even have time to manually drag your mouse over to the exit button. In scalping, capital preservation is the whole shebang. It's your only true priority.
Now, before we wrap up, we've got to hit the standard disclaimer, which is the ultimate reality check here. All trading involves significant risk, and you should never trade or invest money you cannot afford to lose. This isn't just a legal formality. It's the fundamental truth of the financial markets. These strategies, the 5-minute charts, the London Opens, these are educational concepts analyzing historical data and probabilities. They absolutely do not guarantee future wealth. When you enter a trade, you're stepping into a ruthless arena filled with institutional professionals, high-frequency algorithms, and extreme volatility. Respect the risk at all times.
So, I have to ask, which time frame best fits your actual lifestyle? Are you the patient swing trader who wants to check the daily charts once a morning and then go live your life? Or do you have the intense focus, the rigid emotional discipline, and the sheer availability to battle it out in the 5-minute scalping trenches? Think about it. Which specific Bitcoin session gives you the cleanest opportunities based on your own schedule and psychology? Let us know. Thank you so much for joining me today. Keep learning, keep objectively analyzing those charts, and I will see you in the next explainer.